Welcome grade 12s. You are with Ashraf Patel. The focus of this lesson would be on company ledger accounts. Now, you have to remember that when you are preparing ledger accounts for companies, it primarily deals with how do you go about dealing with shares. Now, there has been important changes, and this is relevant to your curriculum. So, we would start off by saying that the Companies Act number 71 of 2008, right? This one here, applicable from 2011 onwards, has introduced several significant changes to the company's law in South Africa. Now, you may be asking, how does it affect me as a grade 12 learner? Two of the most significant changes in terms of the grade 12 curriculum would be: one, shares of no par value. In other words, if you're looking at older question papers, please note that these need to be amended, because we are now dealing with shares of the no par value is now operational from this year onwards. So wherever you see a question with a share that has a par value, remember that is no longer applicable. So in other words, to summarize, we only deal with shares of no par value. Right? It means that the shares do not have a nominal or a par value. Secondly, the buyback of shares. Section 48 allows companies to repurchase its shares from shareholders, obviously under certain conditions. Now, what is the main reason for dispensing of the par value is that it bears no resemblance to the true worth of that share. In other words, if you look at it this way, you often find that the par value of the share would often confuse shareholders, and it would also be of no value to potential investors. Therefore, all shares are now of no par value. This means that shares are issued at an issue price. Very important. What does this mean? It means that the full proceeds of the share issue are credited to the share capital account. Okay? So the entire amount by which we're going to raise from the selling of shares would be credited to my ordinary share capital account. In other words, important. Once again, let's change the color for you there. The share premium account no longer applies. Grade 12s, an appeal to you, when you're working through past papers, right? Please, those questions that deal with shares of a par value and that deal with a premium, remember, these have to be amended. You cannot work with those questions. We also find that now new shares may be issued at a higher or a lower price than the previous issue price. So the price would differ from every time the shares are issued. Once again, why would a company want to buy back or repurchase shares that it had previously issued? One, companies with surplus funds might wish to reduce the share capital, thereby increasing the returns for the remaining shareholders. Right? For example, if you take a piece of cake and you cut it up into 20 pieces, each person would get 1/20th of that cake. But if you reduce that to 10 pieces, then each person would get 1/10, a bigger portion of the cake. Remember that. Keep that in mind. A company might wish to buy out a difficult or a troublesome shareholder who creates problems for the company. Yes, you might find somebody who's creating waves, as we say, and to get rid of that person, you could repurchase those shares. The heirs of a deceased estate might prefer to be paid out for the shares that they have inherited. Very often, you find that because of complications within the estate, some people would want their money immediately. Therefore, it becomes necessary for the company to buy back those shares. A private company might wish to buy back shares in order for a family to maintain control of that private company. Okay, so these are all the reasons that a company would want to buy back its shares. The share repurchase will also allow a company to adjust its debt, the equity ratio, as economic circumstances change. You will notice that shareholders' equity as part of the debt, how it impacts on the debt equity ratio, it may be adjusted with a repurchase of shares. Okay. In terms of the share repurchase, under the new Act, the company's directors have to satisfy two very important criteria. What are these criteria? They are, 1, solvency, and 2, the liquidity test, before concluding a contract to repurchase shares, to ensure that the payment for these shares will not result in solvency or liquidity problems thereafter. In other words, what are we saying? That before a company can repurchase those shares, it must be solvent, 1, and 2, it must be liquid. Right. And remember, your ratios will indicate whether we are solvent or not, and also your liquidity ratios, very important grade 12s, the liquidity ratios will give you a clear indication whether this company is liquid or not. The decision regarding the repurchase of shares is authorized and minuted at a meeting of the board of directors, so it's just not a decision that's taken at haste, it's an informed decision, right? Together with the results of the solvency and the liquidity tests. So 2 tests to pass before solvency, liquidity. The following conditions will have to apply in respect of the solvency and liquidity tests. What are these conditions? 1, when it comes to liquidity, your assets, fairly valued, okay, must exceed liabilities, fairly valued. Note, very, very important here, the historical cost does not apply. In other words, we're talking about assets being fairly valued. That is totally now not in terms of the historical cost of that particular asset. Something totally different. Keep that at the back of your minds. 2, the company will be able to pay its debts as they become due for a period of 12 months after the dividends are distributed. In other words, we're talking about liquidity, the cash situation. The company must be able to settle. Remember, when we're talking liquidity, we're talking about the ability of a company to settle its short-term debts, right? Solvency, the ability of a company to settle its long-term debts. So those 2 are important. Now, the complications that the buyback of shares causes for entries in the books is that the buyback price will exceed the average issue price of the shares. Critical point. The buyback price or the repurchase price will be higher than the average issue price. The difference between these 2 prices effectively relates to a payout of retained income to the shareholders selling the shares. In other words, the difference between the average price and the buyback price, we said it's going to be higher, would obviously impact on the retained income. But as we go into the ledger accounts and as we do the explanations, that will become much, much clearer to you. In this case, both the share capital account and the retained income account will be reduced by the appropriate amounts. Right, so impacting on 2 accounts. What are they? Ordinary share capital as well as your retained income. Also note that companies are no longer registered with the Registrar of Companies. They are now registered with the Companies and Intellectual Property Commission, the Commission or the Commissioner. Keep that in mind. Right, now, if we go and look at what are the double entries that we want to put through when we have a buyback of shares. Number one, when we sell shares, let's go to the start. Very simple. A debit to my bank account. Why? Asset increasing in value, therefore debited. And a credit to my ordinary share capital. Equity account, increasing in value, therefore credited. So the entire amount of the issue price is debited to the bank account and credited to my ordinary share capital. Now let's do the buyback. Remember, sometimes we refer to it as the buyback of shares, other times we talk about the repurchase of shares. Basically the same thing. We are buying back shares from existing shareholders. Who's buying it back? The company. Keep that in mind. Okay, now the buyback of shares will be restricted to values higher, we've alluded to this already, than the issue price of the ordinary shares. What effect does this have on my accounting equation? Watch. My assets will decrease. Why? Because my bank account is an asset. We're assuming it's favorable. It will decrease in value, therefore will be credited. And my owner's equity will also decrease. Which account will decrease? My share capital and my retained income. Let's look at the bookkeeping entries. In the buyback of shares, the accounts that will be affected by the transactions are: one, my bank account; two, the share capital account; and number three, the retained income account. So 3 accounts are impacted with this transaction. What are my double entries? Let's look at my double entries. A debit to ordinary share capital. Why am I debiting ordinary share capital? Because my equity is being reduced by what? By the issue price of the number of shares. And remember, what are we talking about? The average issue price. What is that? Don't fear. When Ashraf is near, we will discuss the average price in detail, so you'll know exactly what we're referring to. What you have to keep in mind is that you are debiting your ordinary share capital account with what? With the average price of the shares that have been repurchased. Important, average. 2, debit the retained income, equity account, decreasing in value, therefore debited. Keep in mind that another equity account is also decreasing. By what amount? With the difference. What are we referring to here? Remember, you have the selling price of the share, right? You have the average price of the share, and obviously the difference between these two will be the difference, and that's what we're talking about in the retained income. Obviously, you're going to credit your bank account with the amount paid for the shares that were repurchased. Now, what is important is that if this was being done under the accounting equation, obviously that's affecting my equity, and this one here is affecting my asset if my bank is favorable. And if my bank, obviously, if my bank is unfavorable, we're dealing with a liability account. Obviously, you've been there, done that. Know the status. What status? The status of your bank account. Now, the difference between the repurchase price and the average issue price of the shares is debited to the retained income. Why? Because this represents the amount of income that had previously been retained by a business in respect of those shares. Remember, what did we say? All the amounts that are retained by a company would be kept in the retained income account. So those shares that we are repurchasing have a portion of the income that is stored in the retained income account, and that is where they need to be reduced from as well. Okay, so now what is it that you need to remember? From this, that we have dealt with so far, basically, if we summarize this into a nutshell, we will say that one, we have shares now of an issue price. Number two, there is no longer a par value. Number three, share premiums do not exist. And in terms of the buyback, three accounts involved: share capital, retained income, and the bank entry. So what you have to remember is how to deal with the theory behind what we have discussed in this part of the lesson. So what we're going to do now is we're going to take an actual example and work through it with you. So what you have to do is you have to stay with Learn Xtra, because then you're going to be an ace in terms of company ledger accounts. We'll take a short break, relax, make sure that you come back with your mind and your soul with us. Welcome back, grade 12s. Yes, remember, we've dealt with the theory. We're now taking an example on a question that deals with company ledger accounts. Let's look at the introduction and the brief to our question. Firstly, we know that the question says, Happy Badges Limited trades in making metric badges. The company is authorized to issue 1 million ordinary shares of no par value. Does that ring a bell? Certainly it does. No longer a par value. Right, what is our concern? The directors are concerned that the market price per share at the Johannesburg Securities Exchange, the JSE, on the 1st of March 2013 has declined from 9 Rand to 6 Rand per share. Right? So a concern. The directors informed the internal auditor to investigate what contributed to the declined market price per share. Okay, you have been requested by shareholders to present information relating to the following company accounts for the period 1st of March 2013 to the 28th of February 2014. Notice what's very important is that I'm taking you slowly and we're doing this here. R, T, F, Q. What does that mean? Read the full question so you know exactly what is expected of you, what you are required to do, and in so doing, you can never ever go astray. Right, required. 1. Calculate the average price of the shares before the shares were bought back. Okay? This means that we have to look for information telling us how shares were sold, right? Then, taking that information, we then have to calculate the average price. They also want you to calculate the price that the company bought back the shares for on the 15th of September 2013. In other words, you got to look at two things. 1, calculate the average price and the price that the company bought back the shares. And then obviously you are asked to do ledger accounts. Which ones are you asked to do? The ordinary share capital, retained income, shareholders for dividends, SARS income tax, ordinary share dividends, income tax, and the appropriation account. So that's your brief on the question. Right. What information do we have? These are my balances on the 1st of March 2013, right? There's my ordinary share capital, there's my retained income. My retained income, just to explain to you, sometimes we use the term accumulated profits. Same thing, just another name for it. There's my SARS income tax account. It has a debit balance, very important, more about that later. and there's a shareholders for dividends. So these are some of the balances that appeared in our books on the 1st of March 2013. Additional information. What do we know? They're giving us a whole lot of transactions regarding the shareholders, regarding the dividends that were paid, income tax details are given to us, provisional payments, information with regards to shares and dividends, how we sold shares, etc., etc. So all the information regarding the question has been presented to you, and now you are then expected to answer the questions. Okay, let's get into the question and go directly to the first question and see what is it that they want us to calculate. Calculate the average price of the shares before the shares were bought back. Now, what information do we need for that? Let's look at the information. One, we are told that we issued at the beginning of the year, our information tells us that we have 100,000 shares valued at 500,000 Rand. Therefore, let's do that. 100,000 shares valued at 500,000 Rand. Okay, then what else happened? Information regarding our shares. Let's see what information we have. We issued 40,000 no par value shares for an amount of 240,000. Okay, so let's include that now. So we had 40,000 shares and these were valued at 240,000 Rand. Okay, so what am I doing? I'm gathering information regarding all the shares that we have sold. Remember, that was my balance at the beginning, right? These are further shares that were sold, and if we take this, okay, that gives us a much better view so we can see exactly what we're doing. Let's go back and see more information regarding shares. Here goes. We issued another 50,000 no par shares at 8 Rand per share. Obviously, when we do that, what are we going to say? 50,000 shares, okay? So 50,000 shares. Let's just extend our page again so we have it in view, right? So we had 50,000 shares. Remember, these were sold at 8 Rand per share, and if you do your multiplication, very simple, that will give you a value of 400,000 Rand. Okay, now, important, watch this closely. Add the value of your shares, right? And in order to add our value of our shares, we got 500,000 Rand, 500,000, 1, 2, 3, plus 240,000, right, plus 400,000, right? Are my zeros correct? Yes, they are. To give me a value of 1,140,000. In other words, the total value, 1,140,000, is the Rand value of my shares. Rand value. Okay, now, what is this represented by? Let's check. It's represented by, now I want number of shares. That is 100,000, 1, 2, 3, plus 40, 1, 2, 3,000. That's the second one, watch. And the third one, the 50,000 shares that were sold. The total of that would be 190,000. Now please note that this is the number of shares and that's the value of those shares. Okay, so obviously, what are we now going to do? This is what we're going to do. We're going to say, take the value of my shares, which is 1,140,000, okay, divided by the number of shares, which is 190,000, and 1,140,123 divided by 190,123 will give me a value of 6 Rand. That, grade 12s, is the average issue price of my shares. So what is it that we have to remember? Take the Rand value divided by the number of shares, and that will give you the average price per share that we have sold. Okay, we've got that. Let's move on. The next question said, calculate the price that the company bought back the shares for on the 15th of September. Right, let's get to our information. After investigation, the directors realized that the shares were undervalued in the marketplace and therefore decided to buy 45,000 shares, number of shares, for what value? 333,000 Rand. Okay, immediately this tells us that we now have the number of shares that we are buying back, which is 45,000, and how much did we pay for those shares? We paid 333,000 Rand for those shares. In other words, now we can go back and say, right, let's do this. What do we know? We paid 333,000. Okay, that was the Rand value of the shares. How many shares did we buy back? We bought back 45,000 shares. Okay, and if we now do our calculation, we find that 333,000 divided by 45,000 would give me a value of 7 Rand and 40 cents. Okay, notice the difference. What is the 7 Rand 40? That's the value at which we repurchased those shares. What was the average price? Can you recall what was the average price? Yes, we worked it out. The average price of those shares was 6 Rand. Immediately you can see the two prices that we're going to be working with are, one, the buyback price of 7 Rand 40, as well as the average price, which was 6 Rand. So that was the two figures that we're going to be working with when we start our calculations. All that these were to do the necessary calculations. Now, obviously, you can see the importance. If you get your calculation wrong, then this is going to impact negatively on your ledger accounts. So please ensure that you get these calculations correct. Okie dokie, let's move on. We now come to the ledger accounts that we are supposed to prepare. Let's start off with the ordinary share capital account. Step number 1, always find your balance. Right, there's my ordinary share capital account, and the balance in that account is 500,000 Rand. Therefore, we all know this, don't we? That ordinary share capital is that color, it doesn't seem too good. Let's try another brighter color. That's better. 500,000 Rand. And what is that? That is my balance at the beginning of the year. Notice it's my balance brought down. Notice also that it's on the credit side because it's an equity account. Obviously, you're going to put in the date, and the date for this was March the 1st, and you're going to put in the necessary, right? In terms of the year and what have you. Most important is we've put in the balance into my ordinary share capital account. Okay, then I also need the balance for my retained income, and the balance in the retained income is an amount of 98,000 Rand. Therefore, equity account, balance R98,000. Okay, so the moment you're working with these ledger accounts, the first thing that you're supposed to do is to put in the necessary balances. Right, next one, let's see what do we have here. We have the shareholders for dividends account, and let's find the balance. Shareholders for dividends, we all know that this is a liability account. Why? This is the amount that we owe to our shareholders. Therefore, on the credit side of the account, the balance of your account is, the amount was 85,000 Rand. Liability on the credit side, a balance of 85,000 Rand. The next account that we have there is our SARS income tax. And what do we know about SARS income tax? Remember, I alluded to this earlier on. SARS income tax specifically telling you it's a debit balance of 15,000. Now, please be careful with SARS income tax. Why? Because if I ask you the question, what type of an account is SARS income tax? What will your response be? Your response will be, it depends. On what? On the balance. Because if it is a debit balance, it's an asset account. But it could also have a credit balance. Then it would be a liability. So be careful on the SARS income tax. Don't always take for granted that it's a liability. It could be a debit balance, as is our example. And therefore, you find that in this account here, SARS income tax, on the debit side, my balance brought down would be an amount of 15,000 Rand. Now you notice that I'm not putting in the dates in all the ledger accounts. You are expected to do that in the exams. I have a license to leave it out. You don't have the license as yet. So you complete it in its entirety. You would find that sometimes I would also use abbreviations. As far as you are concerned, grade 12s, no abbreviations. Make sure you write it out in full. Make sure that it appears. You will notice in the exams your questions will say no abbreviations, etc. Okay, so what have we done? We've put in our necessary balances into the ledger accounts. Okay, now let's go on to the information. The amounts due to the shareholders for dividends were paid. Therefore, immediately we go to my ledger account. There's my shareholders for dividends. The amount was paid. In other words, what was my double entry? A debit to shareholders for dividends, a credit to bank, and therefore we've paid this amount obviously from our cash payments journal, and the amount is 85,000 Rand. Okay, and the other transaction also said that we also received a refund check from SARS for the amount due to us. Therefore, in my ledger account, which ledger account? SARS income tax, I'm receiving money. Therefore, I'm debiting my bank account. I'm crediting SARS income tax. That entry is bank. I'm receiving the money. Understand that. So this entry comes from my cash receipts journal, and the amount is 15,000 Rand. Okay, got that? Brilliant. Let's move on. So, this has been dealt with. we've entered those transactions into the necessary places, and we've done what we were supposed to do. Coming to number 2. Income tax details are as follows. The company paid their first provisional tax in August of 430,000 Rand. Identify the two accounts involved. A credit to bank and a debit to my SARS income tax. Notice, I'm going to change the color again for you so that we can identify what is happening. This is a bank entry where we paid SARS an amount. Let's identify the amount that we paid them. We paid an amount of 430,000 Rand. Once again, my double entry is what? A debit to SARS of 430,000 Rand. A credit to my bank account, obviously CPJ. Now, what is this? This is what we call a provisional payment. We have paid SARS in advance. Okay, so when we've paid them in advance, at this point in time, if you look at your SARS income tax account, you notice that it has a debit balance, meaning SARS owes us money. At this point, if I ask you the question, what type of an account is SARS? Your response will be, it is an asset. Okay, why? Because it has a debit balance. Okay, next transaction. A second provisional tax payment of 440,000 was made, so go back to the account. A second provisional payment was made to SARS, right? So we paid them, remember, that's your second provisional payment, and we paid them an amount of where was it? Second provisional, 440,000. Okie dokie. Let's go there. 440,000. So you can clearly see what has happened. We have made 2 provisional payments to SARS for the year. Okay, so why do we make 2 provisional payments? The reason, in terms of company legislation, a company is compelled to make 2 provisional payments during the year, and therefore we made our 2 provisional payments. Okay, now just once again, just to draw your attention to something, please guys. I'm sure you love dates. I'm talking about the dates that you eat. Yes, they're very nutritious, but as far as accounting is concerned, make sure that you insert your dates. I had told you early on, I am not doing it obviously because of time constraints, but you must put in your dates when you're working in your ledger accounts. Yes, when you are doing calculations, by all means, leave them out. Be as brief as possible. It's a calculation. But if you requested, like the question wants you to do a proper ledger account, make sure that you insert all your dates. Okay, so we have done our 2 provisional payments, and we are now told that the income tax for the year amounted to 900,000 Rand, being 30% of the net profit. Okay, 900,000 is now your income tax. So what's your contra entry? Remember, you're going to debit this account here. Let's identify that account. Let's get to that account. Here it is. Why are you going to debit income tax? Because it's an expense account. It's an expense to the company. Debit the income tax. My amount is 900,000 Rand. Okay? My details would be SARS. Now yes, SARS is an accepted abbreviation, so you can use it. By all means, we don't expect you to write South African Revenue Services. Then you'll probably need an answer book that looks like some other type of answer book. Obviously, SARS is an accepted abbreviation, and income tax, this you will write in full. I'm abbreviating. It's my journal entry. I'm debiting my income tax account. Why? Because it's my expense account. What am I crediting? I'm going to credit my SARS income tax account. Let's find it. Here it is. Remember, I'm going to credit my SARS income tax account. My detail is going to be income tax. And the amount is 900,000 Rand. Okay, so now, have I completed all my transactions in respect of SARS? Yes, I have. What do I now do? I balance my account, okay? And when I balance my account, I will find that the credit side is greater. The total on this account is 915,000. Okay? So 915,000. Take your calculator and you say 915,123 minus 15,000 minus 430. Watch, what am I doing? I'm subtracting all these figures here. I've subtracted the 15, I subtracted the 430 minus 440,000, and my answer is 30,000. In other words, the balance on this account now is 30,000 Rand. That's my balance. Carried down, and my balance brought down would be a 30,000 Rand on the credit side. Notice this account started with being a debit balance at the beginning of the year. Notice, and it ended off with a credit balance at the end of the year. So that's why we said, once again, what type of an account is SARS income tax? Answer, it depends. On what? On the balance. Beginning of the year, asset. End of the year, liability. Okay, done and dusted. Let's move on. So we've sorted all those stories out, right? We are told that the directors decided to pay an interim dividend of 125,000 Rand. Obviously, two accounts involved. Identify your two accounts involved. We paid a dividend. Therefore, we're going to credit bank. That entry is known to you. Paid, reducing my cash. A debit to ordinary share dividends. Let's get to that nominal account. There's my ordinary share dividends. My entry would be, I just pick up another pen there. My entry would be bank, and we paid an amount of 125,000. Let's just verify that. There's it, 125,000. Therefore, here you got 125,000. That was the interim dividend that was paid. Remember, the moment you pay a dividend, immediately it becomes an expense. A debit to your nominal account, it's an expense to the company, a credit to bank. Okay. Is there any more information? Yes, there is. The directors recommended and declared a dividend of 245 cents per share to the shareholders. The bought back shares did not qualify for the final dividend. Right, what do we now have to do? We now have to go back and see how many shares did we have in issue. Right, let's look at that. Remember, the number of shares that we had in issue, if we take it back, was 1,190,000. That was the value of those shares, if you recall, from our very first question, right? And this was represented by, let's just find it so we know we have the correct figures here. There's it. 1,140,000. What did we have here? Let's just check. Let's just verify. I don't want to use the wrong figures. Otherwise, we're going to have a mess with our calculations. So here goes. 1,140,000 represented by 190,000 shares. Okay, now the 190,000 is of significance. Let's take the 190,000 into our calculation. $190,000. Right, 190,000 shares is what we had issued, right? Remember that we had bought back some shares. How many shares did we buy back? Let's look at our information. It will tell us that we bought back 45,000 shares. Therefore, $45,000 shares is the number of shares that we bought back. Let's subtract that. And therefore we got a figure here of 190,000, 190, 1, 2, 3, minus 45,000 will give me a figure of 145,000 shares. That's the number of shares. Keep that in mind. Right, so if we have 145,000 shares, let's look at our dividend. Our dividend tells us that the final dividend was recommended was 245 cents per share. In other words, what we have to now do is multiply that by 245 cents, which is 2 Rand 45, and let's do that on our calculator. We got 145,000 shares times 2.45, and my answer is 355,250. 355,250. What is my double entry? My double entry is a debit to ordinary share dividends, right? The figure being 355,250. So 355,250. That is my double entry. Watch, a debit to ordinary share dividends. What am I going to credit? I'm going to credit my shareholders for dividends. Right. And that takes me, obviously, to my shareholders for dividends account. Credited 355 and 250. 250. What is this? Ordinary share dividends. Okay, so what have I done? I've now completed this entry in respect of my dividends. I've done my final dividend, and therefore I recorded the transaction. Remember this one here, what was my double entry? Just to recap, a debit to ordinary share dividends and a credit to my shareholders for dividends. Why? Because this is a final dividend that is recommended. It's not paid as yet, and therefore that particular double entry. Okay, now coming back to this one here. After investigation, the directors realized that the shares were undervalued in the market, and therefore we bought back 45,000 shares for 333,000 Rand. Okay, now we go back to these two accounts that we worked with originally, and we're going to ask ourselves, how does it impact on these two accounts? Remember what we said. We've got the average price and we've got the buyback price. So therefore, let's work with those two figures now. We bought back 45,000 shares. And remember, we paid a total of 333,000 Rand for these shares. Okay? We said the average price, if you recall from our calculations, was 6 Rand. Okay, that was the average price of the shares, and we also calculated the selling price per share to be 7 Rand and 40 cents. Okay, calculation time. Watch. Number one, 45,000 shares were bought back. times the average price of 6 rand to give me a value of 270,000 rand. In other words, what am I saying? This is what I'm saying. Ordinary share capital, 270,000 rand. Okay? What is that? That's my buyback of the share. So my contra entry is a debit to ordinary share capital. There's my debit entry. And a credit to my bank. Watch the figure. 270,000 rand. Why grade 12s? Because we said 45,000 times the 6 rand. Remember on your calculator, you calculated 45,000 times the 6 rand. Why? Because that was the average price. Now, what's the difference between the average price and the selling price? Watch, 7 rand 40 minus your 6 rand will give you a figure of 1 rand and 40 cents. Multiply that by 45,000 and this gives you a figure of 63,000. Now, let's just look at these two figures. The 63,000 is the price above the average price. And that 63,000 is going to impact on my retained income. 63,000 rand. This comes from my entry as a result of my buyback. Clearly you can see that the 63,000 plus the 270,000. Just let me show it to you so you can see it. The 63,000 plus the 270,000 will then give you the 333,000, which is the value of the shares that we had repurchased. So critical, average price into the ordinary share capital account, average price. Price above the average price into my retained income account. Don't ever forget that. Make sure you remember it. Okay, now what happens? Remember that your balance sheet accounts, obviously your ordinary share capital account will now have the other transactions. What other transaction will we have in here? Let's check. Let's see, because we haven't recorded them in here. These are the transactions that we still need to record with regards to our shares. There's a 40,000 for 240,000. Therefore, in my ordinary share capital, 240,000 was the additional shares that I sold. Obviously, the contra entry is a debit to bank and a credit to my ordinary share capital account. Okay, then I sold further shares. Let me identify those. We issued another 50,000 shares at 8 rand. Remember, the value was 400,000. Therefore, 400,000 was the second issue of shares that we had. Once again, my contra entry would be a debit to bank and a credit to my ordinary share capital account. You will notice that I've got my opening balance, further shares that were sold more shares, bought back shares. All that is left for you now to do is to balance the ordinary share capital account. Okay, and if we balance that account, let's do the balancing of it. What do we have? 500,000 plus 240,000 plus 400,000 is equal to 1,140,000, 1,140,000. Remember, minus what we bought back, 270,000, and the new balance in this account is a value of 870,000 rand. Okay, so that's it. We have now balanced the share capital account and that is what it looks like. Okay, what about retained income? We've got 2 entries. We still have to do further entries. We'll come back to the retained income account. Okay, the next account that we're dealing with, our other balance sheet accounts were, there's your shareholders for dividends account. Obviously, you're going to balance these accounts as well. Why they are balance sheet accounts? Let's do that. You will notice that the 85,000 cancels out with the 85,000, and therefore, it's a simple method of balancing this account. 355,250 is your balance at the end of the year. That is your balance carried down, which will be your balance brought down for the next year, obviously an amount of 355,250. Okay, if you want to, let's do that. Let's put in the total so you can clearly see it. It's 355,250 plus 85,000, and the totals are 440,250. So that's let's get that figure again. 440,250. Remember, this is what we call our train line totals. The totals on either side of the account. We do know that in the inner ledger account, obviously the 2 sides must be the same when we are balancing the account. Okay, so that's sorted. I've sorted my SARS income tax account already, so that's sorted. I'm now left with my 2 nominal accounts. And what must now happen to my nominal accounts? Watch the space. Number 1, these are nominal accounts. In other words, they need to be closed off because nominal accounts are transferred to a final account. In this case, we're going to transfer these 2 accounts to which account? That's right, the appropriation account. Let's total this account first. So, it's 125,000, which was my interim dividend, recall, plus my 355,250, which was my final dividend, equals 480,250. So, 480,250. What am I doing? I'm crediting my ordinary share dividends to close it because it's a nominal account. I'm doing a closing transfer. I'm transferring this to my final account. Which final account? My appropriation account. Watch my double entry. My double entry is a debit to my appropriation account, ordinary share dividends. It's a journal entry. The amount was 480,250. Clearly you can see the double entry, a debit to appropriation and a credit to my ordinary share dividends. There's it. What happens? This account then closes off. Nominal account. Right. Next nominal account, income tax. Close it off to my appropriation account. Very simple. Credit my income tax account with 900,000. What have I done? I've closed off that account. It's a nominal account, closed off. And then what do? I go into my appropriation account and I've got income tax and the amount is 900,000. Okay? So, I've closed off the 2 nominal accounts. What were they? Dividends and income tax into my appropriation account. What do I now bring in? Now I bring in my net profit before taxation. The net profit before taxation, you find that you are given information that the income tax for the year amounted to 900,000. being 30% of the net profit. So therefore, this means that we now have to do a calculation. Right, what are we saying? We're saying that 30% is equal to 900,000. We want to know what was the total amount before taxation. In other words, the 100% is equal to my unknown. Right? Cross multiply. 30x is equal to 900,000 times 100. Okay? Let's take our calculator and we say fine. Let's do that. 1,000 times 100. Okay, you can see that. Divided by 30 to find your unknown. And voila. What do we have? Our net profit before taxation was a total of 3 million rand. Okay, so let's use the 3 million. Let's slot it in. And that is from my profit and loss account. The figure is 3 million rand. Okay. I now have all the components that I need in my appropriation account. What am I now going to do? Right, watch this space carefully. I take my 3 million, which is my profit and loss figure, minus 480,250 minus 900,123, and this gives me a figure of 1,619,750. Okay, now what is this? This is what I call my retained income. Obviously, my two totals will be 3 million on either side because this account also closes. Now, if I debited my appropriation account with 1,619,750, then I have to do something else. What is it that I have to do? I have to credit my retained income account coming from my appropriation. And the amount was, our calculator will give it to us, 1,619,750. Okay? Now, what do? I say that plus 98,000, which was my opening balance, is equal to 1,717,750 minus 63,000 to give me a figure of 1,780,750, and notice that that is now my new balance that I'm going to be using. Let me just put in my train line total for myself, 750. There's my balance in my account, which is my balance carried down. My balance brought down for next year would be 1,700,000 and is that figure correct? Let me just check it up one more time. Let's just make sure we have the correct figure there. Let's just do it one more time. It was the 1,619,750 plus 98,000 to give me a figure of 1,717,750, which is fine, minus the 63,000. Aha, I knew there was a mistake there. Can you see that? Lucky we picked it up. The new balance must be, let's remove that one and that one. You see how important it is to make sure that your calculations are correct? Always check. How did I pick it up? That balance there can never be larger than your train line total. Doesn't make sense. So be wary when you are calculating. Once again, remember, it's the 98,000 plus the 1619750 to give me 1,717,750 minus the 63,000 to give me a figure of 1,654,750. Now I'm sure that figure is correct. 1,654,750. Okay, now look at my retained income. I have my opening balance. I have the figure coming from my appropriation that I retained. So there's the figure. Then I have the buyback portion. Remember, the price above the average price, and that is my new balance in my retained income account. However, at this stage, I think it's important for me to mention that there are various options when dealing with your retained income. Please make sure, once you have chosen a particular method, stick with that method and I'm sure you won't have problems. But I also want to mention that there are different methods in which you can deal with the retained income account. Obviously, if you need to check your source material, look at other learning and teacher support material, and they will give you the other options that you can use to complete that retained income. This is the method that I have chosen, and I feel it's the easiest one for you to remember, and yes, this is definitely acceptable for examination purposes. Well, grade 12s, now you are in a position to ace any questions dealing with the ledger accounts of companies. Guys, remember, you have to aim for the moon, because if you don't get there, definitely you're going to be a shining star, Ashraf's shining star. Until our next lesson, keep focused, practice, 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 and look out for lessons on accounting on Learn Extra. Until next time, cheerio. Retain income to the shareholders selling the shares. In other words, the difference between the average price and the buyback price, we said it's going to be higher, would obviously impact on the retained income. But as we go into the ledger accounts and as we do the explanations, that will become much, much clearer to you. In this case, both the share capital account and the retained income account will be reduced by the appropriate amounts. Right, so impacting on two accounts. What are they? Ordinary share capital as well as your retained income. Also note that companies are no longer registered with the Registrar of Companies. They are now registered with the Companies and Intellectual Property Commission. The Commission or the Commissioner. Keep that in mind. Right, now, if we go and look at what are the double entries that we want to put through when we have a buyback of shares. Number one, when we sell shares, let's go to the start. Very simple. A debit to my bank account. Why? Asset increasing in value, therefore debited. And a credit to my ordinary share capital. Equity account, increasing in value, therefore credited. So the entire amount of the issue price is debited to the bank account and credited to my ordinary share capital. Now let's do the buyback. Remember, sometimes we refer to it as the buyback of shares, other times we talk about the repurchase of shares. Basically the same thing. We are buying back shares from existing shareholders. Who's buying it back? The company. Keep that in mind. Okay, now the buyback of shares will be restricted to values higher, we've alluded to this already, than the issue price of the ordinary shares. What effect does this have is that it bears no resemblance to the true worth of that share. In other words, if you look at it this way, you often find that the par value of the share would often confuse shareholders, and it would also be of no value to potential investors. Therefore, all shares are now of no par value. This means that shares are issued at an issue price. Very important. What does this mean? It means that the full proceeds of the share issue are credited to the share capital account. Okay? So the entire amount by which we're going to raise from the selling of shares would be credited to my ordinary share capital account. In other words, important. Once again, let's change the color for you there. The share premium account no longer applies. Grade 12s, an appeal to you. When you're working through past papers, right? Please, those questions that deal with shares of a par value and that deal with a premium, remember, these have to be amended. You cannot work with those questions. We also find that now new shares may be issued at a higher or a lower price than the previous issue price. So the price would differ from every time the shares are issued. Once again, why would a company want to buy back or repurchase shares that it had previously issued? One, companies with surplus funds might wish to reduce the share capital, thereby increasing the returns for the remaining shareholders, right? For example, if you take a piece of cake and you're going to cut it up into 20 pieces, each person would get 1/20th of that cake. But if you reduce that to 10 pieces, then each person would get 1/10, a bigger portion of the cake. Remember that. Keep that in mind. A company might wish to buy out a difficult or a troublesome shareholder who creates problems for the company. Yes, you might find somebody who's creating waves, as we say, and to get rid of that person, you could repurchase those shares. The heirs of a deceased estate might prefer to be paid out for the shares that they have inherited. Very often, you find that because of complications within the estate, some people would want their money immediately. Therefore, it becomes necessary for the company to buy back those shares. A private company might wish to buy back shares in order for a family to maintain control of that private company. Okay, so these are all the reasons that a company would want to buy back its shares. The share repurchase will also allow a company to adjust its debt. The equity ratio as economic circumstances change. You will notice that shareholders' equity as part of the debt, how it impacts on the debt equity ratio, it may be adjusted with a repurchase of shares. Okay. In terms of the share repurchase, under the new Act, the company's directors have to satisfy two very important criteria. What are these criteria? They are, one, solvency, and two, the liquidity test. Before concluding a contract to repurchase shares, to ensure that the payment for these shares will not result in solvency or liquidity problems thereafter. In other words, what are we saying? That before a company can repurchase those shares, it must be solvent, one, and two, it must be liquid. Right? And remember, your ratios will indicate whether we are solvent or not, and also your liquidity ratios, very important grade 12s, the liquidity ratios will give you a clear indication whether this company is liquid or not. The decision regarding the repurchase of shares is authorized and minuted at a meeting of the board of directors. So it's just not a decision that's taken at haste. It's an informed decision, right? Together with the results of the solvency and the liquidity tests. So two tests to pass before solvency, liquidity. The following conditions will have to apply in respect of the solvency and liquidity test. What are these conditions? One, when it comes to liquidity, your assets, fairly valued, okay, must exceed liabilities, fairly valued. Note, very, very important here, the historical cost does not apply. In other words, we're talking about assets being fairly valued. That is totally now not in terms of the historical cost of that particular asset. Something totally different. Keep that at the back of your minds. Two, the company will be able to pay its debts as they become due for a period of 12 months after the dividends are distributed. In other words, we're talking about liquidity, the cash situation. The company must be able to settle. Remember, when we're talking liquidity, we're talking about the ability of a company to settle its short-term debts, right? Solvency, the ability of a company to settle its long-term debts. So those two are important. Now, the complications that the buyback of shares causes for entries in the books is that the buyback price will exceed the average issue price of the shares. Critical point. The buyback price or the repurchase price will be higher than the average issue price. The difference between these two prices effectively relates to a payout of Welcome, grade 12s. You are with Ashraf Patel. The focus of this lesson would be on company ledger accounts. Now, you have to remember that when you are preparing ledger accounts for companies, it primarily deals with how do you go about dealing with shares. Now, there has been important changes, and this is relevant to your curriculum. So, we would start off by saying that the Companies Act number 71 of 2008, right? This one here, applicable from 2011 onwards, has introduced several significant changes to the company's law in South Africa. Now, you may be asking, how does it affect me as a grade 12 learner? Two of the most significant changes in terms of the grade 12 curriculum would be: one, shares of no par value. In other words, if you're looking at older question papers, please note that these need to be amended because we are now dealing with shares of the no par value is now operational from this year onwards. So wherever you see a question with a share that has a par value, remember that is no longer applicable. So in other words, to summarize, we only deal with shares of no par value. Right? It means that the shares do not have a nominal or a par value. Secondly, the buyback of shares. Section 48 allows companies to repurchase its shares from shareholders, obviously under certain conditions. Now, what is the main reason for dispensing of the par value?